All right, let's break down what's going on with Reliance Global Group, ticker RELI, because something really interesting happened with their Q2 earnings. You had management on one side, painting this picture of a major strategic turnaround, and then you had the market, which, well, did the complete opposite. We're going to unpack that huge disconnect between their story and the stock's performance. And when I say the market reacted, I mean it reacted fast and hard. Just look at this number. In a single day after their earnings call, the stock plummeted 16.4%. And this wasn't some quiet little dip. No way. The trading volume was nearly 4 times the average. That tells you people were actively, and I mean actively, rushing for the exits. So this is the big mystery, right? On paper, management was saying all the right things. They cut debt, they're talking about new tech initiatives. It all sounds great, but clearly investors heard something completely different on that call. So what was it? What spooked them so badly that they hit the sell button? Well, to figure that out, we've got to dig into the financials. Okay, first up, the bleeding bottom line. Let's start with what probably hit investors first. No matter how good a story management tells you about the future, if the numbers right here, right now, look ugly, they're going to be really tough to ignore. So take a look at these figures. The problem here wasn't just that they lost money. It's that the losses are getting worse. A lot worse. Their GAAP net loss didn't just grow, it ballooned, going from $1.5 million last year to over $2.7 million this quarter. And even if you look at their own adjusted numbers, the loss more than doubled. For anyone watching this company, seeing losses accelerate like that, that's a massive red flag. So you have to ask, where is all this red ink coming from? Well, it's pretty simple. Their expenses went through the roof. Salaries and wages shot up 30%. And general and admin costs? They soared by 50%. Now sure, management had explanations. They talked about non-cash items and one-time costs. But from an investor's point of view, it just looks like the business got a whole lot more expensive to run. But okay, those bleak financials, they're only half the story. While the market was obsessing over the losses, management was busy pitching a complete strategic reset, a long-term vision for the company. So let's look at their side of the argument. And the CEO, Ezra Bayan, put it pretty bluntly. He said, these aren't just tactical wins. They're foundational steps that position Reliance for long-term success. What he's really saying there is, hey, forget about this one bad quarter. Look at the big picture. We're rebuilding this whole company from the ground up to be much stronger for the future. And the cornerstone of that new foundation was a massive move to clean up their balance sheet. It was actually a pretty slick 3-step play. 1, they sold an asset for $5 million in cash. 2, they immediately used that to pay down $5.6 million in debt. And 3, just like that, they cut their long-term debt almost in half. The real kicker, that single move frees up $1.8 million in cash every single year. Now, beyond just the debt, they highlighted 2 other key pillars. First is this OneFirm strategy, which is basically a plan to get all their separate agencies to work together, streamline everything, and hopefully cut costs. And second, they're pushing to grow their tech platform RELI Exchange by adding new ways for their agents to make money, like the new auto leasing service they just rolled out. Okay, so now you see the 2 competing narratives, right? On one side, you've got a financially painful quarter. On the other, a pretty promising long-term strategy. This brings us right back to our core question. Why did the market completely ignore the strategy and focus only on the pain? It really boils down to this classic contrast. Management was selling future potential, a cleaner balance sheet, more efficiency, new growth. But the market was focused on the present reality. The losses are getting wider, the expenses are heavier, and this is a big one, there's a real risk of shareholder dilution from a potential $6.75 million private placement. In the battle of jam tomorrow versus pain today, investors chose to react to the pain. So what's the call for the next quarter? We've weighed the ugly financials against the strategic promises. Here's our forward-looking view and our official rating. Looking ahead, here are the key things to watch for. In Q3, they should book a nearly $3 million gain from that Fortman sale, which will make the numbers look a lot better. We also need to see if that OneFirm strategy actually starts delivering real cost savings. And finally, any news on their paused acquisition of Spenner or updates on their capital plans will be absolutely critical. So, taking everything into account, our rating is underperform. Look, cleaning up the balance sheet is a genuinely positive step, no doubt about it, but it's just completely overshadowed by the widening operational losses. Until the company proves its strategy can deliver actual financial improvements and a clear path to profitability, we expect the stock will continue to lag the market. The big question for the next call is, how much more pain today will investors tolerate for the promise of jam tomorrow? And just a reminder, this is not financial advice. All investment decisions should be made with a qualified professional.